You're listening to Capital Topics, episode number 70. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In our podcast today, we'll review a study from Elm Wealth Management entitled When a Crystal Ball Isn't Enough to Make You Rich. Enjoy! Hello, James. How are you today?
I'm very good, François, and how are you?
I'm very good, thank you. So I'll start. We have often mentioned on our podcast that we don't have a crystal ball and that without one, or the benefit of hindsight, it's very hard to know with certainty where the markets are heading. In that sense, having a crystal ball to predict markets is every investor's dream. But is having that crystal ball really enough to make us rich? Well, that's the topic we will cover today based on a recent study by Victor Haghani and James White from Elm Partner Management in the US. The title of this study is When Having a Crystal Ball Isn't Enough to Make You Rich.
Well, I agree too, François. That's my dream. I'd love to have a crystal ball. But again, I think their study is very interesting. The authors were inspired by a tweet on X, I guess it's called, what used to be called Twitter, from Nassim Nicolas Taleb, mathematical statistician, former academic, and author of the best-selling book entitled The Black Swan, The Impact of the Highly Improbable. So that said, and I quote what he tweeted, if you give an investor the next day's news 24 hours in advance, he would go bust in less than a year.
Yeah, that's correct, James. And to test this in real life, Haghani and White ran an in-person experiment with 118 students. These students were from 4 universities on the U.S. East Coast, and 90% of the students were in graduate programs in finance or in an MBA program. The experiment, named the Crystal Ball Challenge, gave the participants the opportunity to grow an amount of $50 that was given to them by trading in the S&P 500 index and the 30-year U.S. Treasury bonds based on the information on the front page of the Wall Street Journal 1 day in advance. In order to avoid giving participants further information, clues like stock prices and other data were blacked out from the pages.
The Crystal Ball Challenge covered 1 day per year for a period of 15 years from 2008, therefore the global financial crisis, and went all the way to 2022. The days were presented and chosen randomly from a set of days that were major news events, specifically employment reports, Fed announcements, or purely random days. But all the set of days chosen would be in the top half ranked by overall market volatility.
Exact. And for each of the 15 days, the players were allowed to place one trade on the S&P 500 index and one trade on the 30-year U.S. Treasury bonds. The players could either go long or short, and they could also use leverage up to 50 times.
Wow, there's a bit of jargon in there, perhaps, for some of our listeners. So to simplify, what it means is that they were given the option to buy, in other words, go long the S&P 500 index, so a broad market of large cap stocks, and the same for the Treasury bonds. They were also given the alternative to sell, in other words, short the same investments. When you buy or go long, you obviously expect prices to go up, and when you sell or go short a security, you believe the price of the security will decrease. The players were also able to apply leverage, which means that they could borrow to increase the size of their trades. And applying leverage can amplify your profits if you are right on your buy or sell decisions, but it also means greater losses when you bet wrong.
Yeah. Before we go over the results for the 118 students, I think our listeners will be pleased to know that they can test themselves and play the Crystal Ball Trading Challenge. We'll make sure to put a link to the game with the podcast. I've played it myself. It's a lot of fun for a finance lover like me. We'll share my results a bit later. Up to now, more than 1,500 people have played the game on the website for fun. As unlike with the students, there was no money involved here.
So, François, Were the students able to use the benefit of knowing next day's news in advance they had on the front page of the Wall Street Journal to their advantage?
Well, James, some will be surprised, but the answer is no. The students in the experiment did not perform very well despite having valuable information ahead of time. They were only able to grow the $50 they were given to $51.62 for a weighted average return of only 3.2%. The paper mentions that this poor result is statistically indistinguishable from breaking even. The report goes on to mention that about half, 45% of the students lost money, and that 16% of them lost everything. This being said, about 20% of them maxed out their profit to $100. The players were only able to forecast the correct direction of stocks and bonds only 51.5% of the time.
Well, that's what you'd expect from a coin toss. So does the paper give any reason for these poor results?
Well, James, yes, it does. First, as I've mentioned, not being able to guess the direction of stocks and bond is the primary reason. As you've highlighted, James, they marginally did better than a coin toss. If we look closer at the details, they got their bets on the S&P 500 index correct only 48.2% of the time, but they did a bit better with bonds, being correct 56.2% of the time. The other reason cited for poor result was poor trading size.
Well, can you explain to the audience what that means, François?
Well, James, if you remember, the rules stipulated that the players could use leverage up to 50 times when they made their trades. However, the results demonstrates that they did not use that leverage to their advantage. For example, although they had a better betting average on the bonds, betting correctly 56.2% of the time, they did not use that to their advantage since the leverage placed on their bond bets was lower than the leverage used on their bets on stocks.
François, the reverse must then hold true on their stock bets.
Correct, James. They used more leverage on their stock bets, but their betting average on stocks was lower at 48.2%. So this combination of higher leverage and lower betting average also hurt the results. Here's a quote from the report on this regard, and I quote, "It seems that our players, on average, did not follow a strategy of placing bigger trades on those that they had a higher probability of getting right. Perhaps this is due to them not knowing which ones they had a higher probability of getting right, or perhaps they were not following a disciplined sizing strategy."
So, François, I guess it's fair to say that this confirms, what I feel intuitively, which is that although the players had the headlines from the front page of the Wall Street Journal, they really weren't convinced of the impact that the news would have on the stock or bond markets. Otherwise, they would have shown more confidence by increasing leverage on the trades they were certain of getting right.
I think you're right, James. If you knew for certain the impact of a particular piece of news would have on stocks or bonds, I think you would go all in. If there's still uncertainty, well, you don't bet the whole farm.
Well, again, François, you mentioned earlier that more than 1,500 people played the Crystal Ball Trading Challenge online. So did their results compare to this 118 students?
Well, Jim, their results were worse than for the students, and I think the results could be more representative given the greater number of participants. So instead of breaking even like the students, the median outcome among the 1,500 players was a loss of about 30% of their capital. Only 40% of them made a profit, and 36% of them went bust. So very poor results. This being said, and in full transparency, the authors of the study also invited 5 seasoned and successful macro traders to take the test.
Okay, so what we call a ringer when you want them to come play on your sports team. So how did these smarty pants do, the macro traders?
Well, frankly, James, they did much better than the other 2 groups, but they expressed that the advanced knowledge of the headlines was not incredibly valuable. They felt that they were missing some context around the headlines to help them in their trading decisions. However, they still managed to get 63% of their trades correct, and their median gain was 60%. Remember that the students had only got right their trades at 51.5% of the time.
François, these results are much better than for the others presented in the study, but I'm sure these macro traders had a better feel for the outcome, not just because of their expertise, but also because of their past experience trading on some of these headlines in real life.
Well, that's possible, James, but the study does not go down that path.
So, François, now you got to fess up. How did you do? What were your results?
Well, I can confirm that I'm not a macro trader genius. My results were better than the students and the other players, but they were below the results of the experienced traders. I finished by guessing 59% of my trades correctly and making a 17% return on my trades. I think that similarly to the students, I made poor use of the leverage available since I did not have a lot of convictions in the trades I was making. I often had an idea of the impact of the news, but was never confident enough to increase my bet, although I was not playing here with real money. I'm not a betting man in real life, so I guess that translated in the game. Nevertheless, it's a fun exercise.
So what should our listeners retain from all of this?
Well, James, in real life, without the front page of the Wall Street Journal a day in advance, you have an extra layer of guessing to do. You need to guess the news itself before making any buy or sell decisions. To me, that extra layer of guessing will just reduce even further the odds of success.
Yeah, I agree with that, François. I'd also add that I think this study is just another good example of how hard it is to guess what the markets will do, even with some advanced knowledge. Markets are very efficient at capturing all the information available, and sometimes they don't react to the news the way we think they would. A recent example of this is that no one could have guessed with certainty the outcome of the U.S. election, and surely not the response of the stock and bond markets on the following days.
Yeah, I agree, James. Predicting the future with any precision is very hard and next to impossible. The so-called experts have proven this over and over by failing with their predictions. I believe that aligning your trading strategy based on this guesswork is quite useless. In that sense, here's a quote from Victor Haghani, one of the author of the study, and I quote, "Even if you have the news in advance, it's still really hard to do asset allocation or whatever with a high chance of being right, let alone not knowing what's going to happen." In regards to market efficiency, Mr. Haghani said, and I quote, "If we think about the question of market efficiency in terms of how hard it is to beat the market, this really shows us that it's hard to beat the market even with advanced information. Hence, the markets are pretty efficient."
Well, to wrap this up for our audience, François, as usual, in order to better capture the returns that the markets have to offer, we advise don't time the markets, stay disciplined to your long-term investment plan, and diversify your assets.
Yeah, correct. Okay, so I think that's it. Thank you, James, for sharing your thoughts and expertise today.
My pleasure, François.
So that's it for episode number 70 of Capital Topics. Don't forget, if you'd like to submit question or suggestion for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on January 22nd. In the meantime, make sure to consult the Capital Topics website for our latest blog posts. See you soon.